Welcome to TalkTickers, your essential guide for breaking down earnings calls into insights you can actually use.
Glad to be here.
Today, we're doing a deep dive into the second quarter 2025 earnings call for Health and Tech. They're a company that's, well, really shaking things up in the healthcare benefits space.
They certainly seem to be.
Yeah, and our mission here, as always, is to cut through all the noise. You know, the corporate speak, the dense transcripts. We want to give you the critical numbers, the key strategic moves, basically the stuff that really matters.
So you walk away informed.
Exactly, without having to spend hours listening yourself. And let me just say up front, this was a pretty impressive quarter for them. You can feel the momentum.
Oh, definitely. When you look at Q2 2025 for Health and Tech, it really wasn't just growth. It felt more like accelerated execution across pretty much everything.
Yeah, accelerated feels like the right word.
It really does.
Yeah.
This wasn't just, a good quarter. It felt kind of pivotal.
You can see that acceleration just looking at the top line. Total revenue for Q2, $9.3 million, which is solid.
More than solid. That's an 86% increase compared to last year.
86%.
But here's the really interesting part, I think. Their first half revenue for 2025 is $17.3 million.
Okay.
Get this. That's already 89% of their entire revenue for all of 2024.
Wow. So they basically almost matched their full prior year in just 6 months.
Their 2024 total was $19.54 million.
Yeah.
So yeah, it's like they crammed a year's worth of growth into half a year. That's acceleration.
And, the profitability story is just as good, maybe even better. Adjusted EBITDA for Q2 hit $1.6 million.
Okay, and how does that compare?
That's up an incredible 134% year over year.
134%.
Yeah. And for the first half, adjusted EBITDA was $2.8 million, which again is already a 1.2 times their entire adjusted EBITDA for all of 2024.
So not just growing fast, but growing profitably, very efficiently.
That's exactly it. It shows they're scaling smartly, disciplined, turning more of that revenue into actual profit. It's a really strong sign of good operational management. And that strong management seems to show up in pre-tax income too, right?
Absolutely. That more than doubled year over year. Came in at $0.8 million for Q2.
Doubled. Okay.
And for the first half, pre-tax income was $1.5 million. Again, compare that to 2024, their entire pre-tax income last year was $1.0 million. So they're already at 1.7 times last year's total profit in just 6 months.
That's pretty staggering. And what does that mean as a percentage of revenue?
Well, that first half income works out to 8.8% of revenue, and that's almost a 300 basis point improvement compared to last year.
So the margin itself is improving significantly even as they grow.
Precisely. It's not just growth for growth's sake. It's profitable, healthy expansion.
Okay, and what about the operational side, the sort of underlying driver?
Yeah, the operational numbers really back this all up. Their distribution network, for example, it's expanded to 778 partners now.
778, how does that compare?
That's an 87% increase year over year.
Yeah.
Think about the reach that gives them.
Massive expansion in reach. And are people actually signing up through these partners?
Looks like it. The number of enrolled employees went up by 30%. It's now just under 25,839 to be exact.
So 30% growth in actual users.
Right. So it's not just about signing deals with partners. It's about those partners actually bringing people onto the platform. It shows real adoption, real market penetration. It just paints this picture of, holistic growth, broad and deep, seems sustainable.
Okay, those numbers definitely paint a very positive picture, no doubt about it. But it does make you wonder, how? How are they doing this? What's the strategy behind this kind of acceleration in such a, tough market?
Yeah, that's really the core question, isn't it? And their vision seems crystal clear. Disrupt the old way of doing healthcare benefits.
Okay.
And they're not trying to boil the ocean themselves. Instead, they're building this powerful ecosystem of strategic partners. And it goes way beyond just the traditional insurance brokers.
Right. So who are they partnering with?
Well, they're tapping into cutting-edge third-party administrators, TPAs, the companies that handle claims and admin for self-funded plans.
Okay, TPAs.
And also forward-thinking regional health benefit providers, even service platforms that focus specifically on small businesses.
Yeah.
It's a really diversified approach.
Which means they can expand their reach much faster, presumably without massive overhead costs.
Exactly. Less need for a huge internal sales force.
Smart. And it sounds like they've landed some pretty significant partners, like Vertigard.
Yeah, Vertigard's a great example. It's a TPA, but it's owned by MedImpact.
MedImpact.
Yeah.
They're huge in pharmacy benefits, right?
The biggest independent PDM in the U.S. They manage benefits for 20 million people, handle something like $40 billion in drug transactions a year.
Wow.
So partnering with Vertigard lets health and tech leverage that massive buying power to offer lower drug costs directly. That's real, tangible value.
Deep integration, not just a handshake deal.
Okay.
Who else?
Well, there's Unified Health Plans. They're a top TPA in Kansas, known for a really strong provider network.
Okay.
And Unified is already bringing in big clients, like school districts. Those are complex accounts.
You're right, not easy wins.
Then you've got Hill Group, one of the top-ranked U.S. insurance brokers. Huge footprint, over 2,400 employees, 125-plus locations.
And what's the nature of that partnership?
It's interesting, they're actually co-developing and distributing self-funded health benefit solutions aimed at small and mid-size employers.
Co-developing, so it's deeper than just distribution.
Exactly. It massively boosts health and tech's reach, obviously, but also their credibility. Landing a partner like Hill Group is a big deal.
And they mentioned Bailey Insurance too, right? A fourth-gen agency.
Yeah, partnering on tech-enabled solutions. Plus, they still have ongoing relationships with the really big players like MarshMack Len, USI, Gallagher.
Okay, so it's clear this isn't just luck. It's a deliberate strategy. They're aligning with market leaders, big and small, regional and national.
Right. And the fact that these major players are willing to partner up really speaks volumes about health and tech's platform and their value proposition. It shows they can attract the influencers.
So partnerships are a huge piece. What about their own tech, their product innovation?
That's the other core pillar, really. Their AI-powered platform is kind of the engine driving a lot of this efficiency.
How so?
Well, it lets partners bundle healthcare and insurance options together really smoothly. It gives brokers the tools to create highly customized plans for employers, tailored to specific needs.
Okay.
But the real kicker is the speed. They claim plans can be underwritten in about 2 minutes.
2 minutes? Seriously? Compared to what, usually?
That's the old way. Could easily take 12 to 14 days for a broker to get a quote back.
Days versus minutes. That's not just an improvement, that's transformative for a broker.
Absolutely. Faster than making coffee, like you said.
Right.
And it's not just for the small groups. They're launching an enhanced EDI platform soon.
EDI, electronic data interchange, for systems talking to each other.
Right. And this enhanced platform has automated tools specifically for underwriting large groups. It's slated for a Q3 launch.
And what impact will that have?
They think it could cut the underwriting time for large groups from potentially months down to maybe 5 days.
Months to 5 days? Okay, that opens up a whole new market segment for them, potentially.
Yeah.
Efficiency at the enterprise level.
Exactly. And they're not stopping there. They mentioned new product offerings going into beta testing by the end of Q3. Management hinted they could be breakthroughs.
Intriguing. Vague, but intriguing.
Yeah. And also the Icard program. They're accelerating that. Part of it's expected in August, full rollout by year end.
Oh, card. What is that exactly?
They didn't give a ton of detail, but it sounds like a new service delivery mechanism or feature. And they expect it to start generating revenue in Q1 next year. So a significant new opportunity on the horizon.
Okay, so we've got the partnerships driving reach and credibility, and the tech driving speed, efficiency, and new capabilities. That explains the top line growth pretty well. But what about the bottom line? How are they managing costs while growing this fast? That kind of expansion usually costs a lot up front.
That's a really crucial point, and it's one of the most impressive parts of their story, I think, their cost management. Get this. Sales and marketing costs as a percentage of revenue actually went down year over year.
Went down, while revenue grew 86%. How?
It goes back to the partnership strategy. They leverage their partners' existing sales forces, hundreds of thousands of brokers across all those agencies.
So they don't need a huge internal sales army.
Exactly. They provide their system, often for free, to these partners. It makes customer acquisition incredibly efficient, very scalable.
That makes sense. And does that efficiency carry over elsewhere, like R&D?
It does. R&D expenses also decreased as a percentage of revenue. Basically, they've built the core platform, it's deployed, and now they're benefiting from that initial investment without needing proportional increases in R&D spend.
Okay, so sales and marketing and R&D are becoming more efficient relative to revenue. What about G&A, general and administrative costs? Those usually go up, especially for a public company.
And they did, in absolute terms. You have costs like D&O insurance, that's directors and officers liability board fees, higher legal and audit costs, investor relations, the standard costs of being public.
Right, the cost of doing business on the public market.
Exactly. But if you strip those out, if If you do an apples-to-apples comparison of their core G&A, that also decreased as a percentage of revenue.
Okay, so underlying operational costs are being managed very tightly across the board.
Very tightly. And it shows up in cash flow too. They generated positive operating cash flow, $1.5 million in Q2, $2 million for the first half.
Actual cash coming in the door.
Right. And they ended the quarter with a healthy $8.1 million in cash on hand. So the balance sheet looks strong.
And didn't you mention something about accounts receivable earlier? That seemed noteworthy.
Oh yeah, that was really striking. Despite revenue exploding by 86% year over year,
Yeah.
their accounts receivable, the money owed to them by customers, actually fell by 12% year over year.
Fell by 12% while revenue grew 86%. So they're collecting cash much, much faster.
Incredibly fast.
Yeah.
It signals really strong working capital management. They're not letting growth lead to cash getting tied up. They're growing fast, efficiently, profitably, and managing their cash exceptionally well.
Okay, so let's connect these dots for you, our listener. Thinking about the investment context, what does all this mean?
Well, one interesting thing is how they seem to be defying the usual market cycles. Q2 and Q3 are typically the slow season for health insurance sales, right? Most companies switch plans around year-end or January 1st.
Right, the renewal season is usually Q4, Q1.
But because of their partnerships and the flexibility of their products, especially the fully insured ones that let groups change anytime, health and tech seems to be maintaining strong momentum even during these traditionally slower months.
That's a pretty significant advantage in a cyclical business. Avoids the lulls.
Definitely.
And you mentioned they're getting larger clients now, even without directly targeting them.
Yeah, that's another interesting trend. While they're still focused on small to mid-size, their partners, the brokers and TPAs are bringing them bigger deals. We heard about 100 life groups, 200 life, even one case that was 1,400 lives.
Wow, 1,400. That's definitely moving upstream.
It suggests growing trust in their platform. That the market sees their solution as robust enough for larger, more complex organizations. It's a strong validation signal.
And does that shift towards larger groups change their revenue model at all?
It can influence the mix, yeah. They make money two main ways: underwriting fees, which are typically a percentage of the premium, and program fees, which are often a flat fee per employee per month, based on the services they choose.
Okay.
Larger employers might have a lower average premium per employee just due to scale, but they often choose more services, which drives up those program fees.
So the revenue per employee could still increase even if the premium percentage is different.
Exactly. Mix shifts, but the overall revenue potential can be quite strong, and it shows their model is flexible enough to cater to different client sizes and needs.
So when you put all this together, the rapid revenue growth, the improving profitability, the efficient cost structure, the strong cash flow.
It really looks like a textbook case of operating leverage in action.
Explain that simply for us.
Basically, as their revenue climbs, their costs aren't climbing nearly as fast. Each additional dollar of revenue costs them less to bring in because their core tech and partner network are already largely in place and are highly scalable.
Right, so profit margins expand significantly as they grow.
Precisely. That's what leads to that really strong bottom line growth and makes the whole model look very sustainable.
And the potential market is still enormous, right?
Absolutely massive. You've got something like 60 million people working for small businesses in the US alone. It's easily $1 trillion market overall for health benefits.
And Health and Tech currently has around 25,000 enrolled employees.
Right. So their current penetration is still tiny. A drop in the ocean. It just highlights the sheer scale of the future growth potential if they keep executing like this.
And how does the current environment in the broader healthcare market play into this?
Well, that's maybe one of the most compelling parts right now.
Yeah.
The whole healthcare insurance market feels like it's in flux, right? There's
Right.
a lot of uncertainty.
You see headlines about big rate hikes.
Exactly. ACA carriers talking about 26%, 30% rate increases. There have been administrative changes causing confusion. It's a tough environment for employers trying to manage costs and provide good benefits.
So Health and Tech steps in as
As an alternative, as a source of certainty, maybe. They offer flexibility, cost control, speed, things that directly address the pain points many businesses are feeling with traditional insurance options right now. They're positioned perfectly to capture businesses looking for a better way.
Okay, that provides some really good context. Now, let's transition. And this is the part where we absolutely have to stress. What follows is not financial advice.
Not in any way, shape, or form.
Nope. This is purely for informational, maybe even entertainment purposes. Think of it as a thought experiment. You absolutely need to do your own research, talk to qualified professionals, Don't trade based on a podcast.
Please don't. Okay, disclaimer delivered.
Yeah.
So if we were putting on our imaginary hedge fund analyst hat.
Right. Pitching an outrageous but plausible trade idea to the committee. What have you got for health and tech?
Okay, here's one. Given everything we've discussed, the explosive growth, the partner network scaling, the proven operating leverage, how they're positioned in this messy market,
Yeah.
a potentially interesting, outrageous, but plausible idea could be go long health and tech and pair it with a short position on a legacy PPO carrier.
Ooh, a pair trade. Long the disruptor, short the incumbent.
Exactly. Specifically, find a legacy carrier, maybe one known for being slow, that's struggling with high renewal rate hikes, or is clearly losing customers showing signs of churn.
Okay, that's definitely provocative. Justify that. Why is it plausible, not just outrageous?
Well, the core idea is that Health and Tech's AI platform delivers customized cost-saving plans with that incredible speed we talked about.
The 2-minute underwriting versus days or weeks?
Right. It directly tackles the cost and complexity that are killing employers using old school carriers. Their whole model, the tech, the flexibility, switching plans anytime, it's just built for today's environment in a way the legacy guys aren't.
And the partnerships give them the distribution channel to exploit that advantage.
Precisely. They're not starting from scratch trying to build a sales force. They plug into this massive existing network of brokers and TPAs. It's like a ready-made highway for adoption. They're disrupting from within the existing ecosystem.
So they can potentially steal market share much faster than a typical startup.
That's the thesis. The demand for flexible, affordable solutions is undeniable right now. Health and Tech offers that. The legacy carriers, hampered by old systems and processes, just can't adapt quickly enough.
Okay, so the outrageous part is betting that this smaller, nimbler player can actually make a significant dent in this giant, slow-moving industry.
Yeah, it's David versus Goliath, essentially.
And the plausible part comes back to the hard numbers we discussed earlier.
Exactly. It's not just a nice story. The plausibility rests on the concrete evidence. The rapid profitable scaling, the strong operating leverage, the successful integration with major partners, these aren't projections. They're results they've already delivered.
So there's a demonstrable track record suggesting they can execute this disruption.
Right. It provides a clear, data-driven argument for how they could displace the slower, less efficient incumbents. It suggests this isn't just about grabbing a tiny niche. It's about potentially driving a real shift in how health benefits work.
Okay, an outrageous but plausible trade idea indeed. And again, not financial advice.
Not financial advice.
So, wrapping this up then, health and tech. Clearly a stellar Q2. We saw impressive revenue growth, even more impressive adjusted EBITDA growth.
Driven by that smart partnership expansion, the innovative tech platform changing workflows.
And all underpinned by really disciplined financial management, strong cash flow, great working capital control.
Yeah, they look really well positioned. They're capitalized for more growth, seemingly profitable and sustainable growth. And with new products coming online and that market reach expanding, the tailwinds look pretty strong.
It really makes you think, doesn't it? This whole deep dive into health and tech, it highlights how technology is just relentlessly reshaping these traditional industries.
Ones that seemed unshakable for decades.
Exactly. So the question for you, the listener, to maybe mull over is, what other big, slow-moving elephants out there in other sectors might be vulnerable? Who's next to be disrupted by a smaller, faster, tech-enabled player like health and tech?
That's a great question to ponder. And one last time, remember, this discussion was purely for informational purposes. Always do your own homework.
Absolutely. We hope this breakdown gave you some valuable insights into the health and tech story. If you have questions, thoughts on this call, or ideas for future deep dives, let us know. Thanks for tuning in to TalkTickers.